We're here with David Mckeegan, co-founder of Greenback Tax Services. Thank you, David, for taking time out of your very, very busy day to join us here at Best Mexico Movers.
Oh, thank you. Happy to be here.
Greenback Tax Services is the premier firm doing expat taxes with over 14,000 expats helped so far, and I'm sure growing quickly. And I should also add that I'm a client and I'm very happy with the service. So it's wonderful to be able to meet the man himself, who's the co-founder. And David, I assume your co-founder is, your other co-founder is who?
Is my wife. We actually started the business together.
Great. And when did you start?
We started back in 2009. So we've been doing this for quite a while now.
And as we get started, tell us why you founded Expat Tax Services. Tell me the story behind it, please.
So we were expats before we started this business. My wife and I, we both did our MBAs in Barcelona, and then we moved to London, and we were working in finance in London. And while we're in London, we were continuing to use our US-based accountant to do our US taxes. And one year he royally messed them up. And it took about 6 months for me to sort it out, stand up and making phone calls to the IRS and sending letters back and forth and all this kind of nonsense. And so then, I don't know, maybe a year or so later, we were talking about what we wanted our life to be like. And we really enjoyed our jobs in London, really enjoyed London, but we were starting to have conversations about having a family and things like that, and started to realize that we wanted more flexibility and more freedom. And so we thought, hey, the best way to get that would be for us to start our own business. And so we started trying to come up with different ideas for what that business could be. And the tax business idea just kept rising to the top of the list because we're both pretty financially astute, and it was something we knew firsthand was a real problem, and could really save people a lot of time and hassle if they had somebody doing that for them the right way, as opposed to making mistakes and having to fix them.
Wonderful. So, I guess that's a story of any successful business. You find a problem that's not being solved by someone else, and you step in, and that's what you did.
Yeah, exactly.
So who are your clients typically? Give us sort of a typical profile.
Sure. So our clients are all Americans living outside the US, and they live all over the world. I think we've got clients everywhere that Americans are allowed to be. So there's nobody in Iran, nobody in North Korea, but pretty much everywhere else we either have or have had a client. And most of them are people that are just living and working overseas. Maybe they're sent overseas by a company to fill a role in a different country. Maybe they went to school overseas and decided to stay and got jobs locally. It's across the spectrum, but mainly it's people that don't want to be doing their taxes themselves. They're people that want to put their trust in an expert and have the expert handle that for them.
So are there elements of doing your taxes when you're an expat, which a typical, H&R Block type accountant, I'm not in any way downing H&R Block, just saying that, a typical vanilla US based accountant that typically doesn't deal with expats, opportunities they would tend to miss or mistakes that they would make, which you wouldn't make?
Absolutely. So one of my favorite jokes is we've never met a TurboTax return we couldn't fix. There's lots of ways people can get themselves in trouble if they don't know what they're doing tax-wise overseas. And if you don't have an accountant that understands that stuff and knows what to look for, then they're not going to steer you away from that.
Right. And I imagine there's also, besides the sort of the potential pitfalls of things you could do wrong, I imagine there are certain opportunities that you could take advantage of if you know about it.
Yeah, absolutely.
Is that fair?
Yeah, I had a coffee this morning with a guy I know here in Costa Rica. And these conversations always start the same, right? It's like, I have a friend, and this is his situation. And then as you explain what their friend needs to do, It comes out that it's not their friend, it's them. And so his situation, his accountant who's based in the United States, didn't know about the foreign earned income exclusion or didn't apply the foreign earned income exclusion to his tax return. So he's probably over the last couple of years probably paid somewhere between $60,000 to $75,000 more in tax than he needed to just in the last couple of years.
That's enough to get people's attention. And that's one of the things that I want to talk about in greater detail, the foreign earned income exclusion, because it is a wonderful opportunity for people who are living abroad to pay much, much, much less taxes in a completely legitimate way.
Yep.
But before we do that, I'm trying to sort of put myself in the position of someone who was listening to you for the first time. And listening to everything you're talking about, I would be thinking, wow, that sounds like it's complicated. It's going to cost me a lot of money. Without sort of divulging whatever you would charge, because obviously it's impossible to know ahead of time. Give us sort of a rough idea so people aren't afraid to contact you because they're afraid it's just going to cost them some massive amount of money.
Sure. So we have a policy of doing flat fee pricing based on what the client needs. So if you need your regular 1040 and a 2555, which is the foreign earned income exclusion, or an 1116, which is the foreign tax credit, we charge $485 for that. And then, the price can go up if you have a more complicated situation, if you need state return, if you want us to file your foreign bank account report, things like that get bolted on and, become a little bit more expensive. So, the average client is probably paying somewhere in the $600 to $800 a year kind of range. But we have lots of clients that are just paying the $485 and that's their rate for the year.
And that's for the entire return.
Yes.
Correct?
Yep.
So it's not like this is extra and then you pay extra for the return. So you could pay that to get it done in the United States easily.
Yep.
And so this is actually, in many respects, it might even be less than you're paying now in the United States. And you get the expertise of someone who knows what they're doing, who could potentially save you lots and lots of money by doing your taxes properly as an expat.
Yeah, exactly.
All right. So now let's get to one of my favorite topics, the foreign earned income exclusion. Please give our viewers a little bit of understanding on how that works and what it is.
Sure. So there's two main ways that Americans living outside the U.S. can save on taxes. The first one is called the foreign tax credit, and that's filed on Form 1116, and that is a dollar for dollar tax credit on your U.S. tax return for money that you paid to a foreign government. So an example would be somebody lives in Western Europe, which generally has higher taxes than the United States. And let's say you pay HMRC, Her Majesty Revenue and Customs, 40% of your income in tax. You can take that whole 40% and get a credit against your US tax return. So you don't have to pay anything on your US tax return. And in some cases, you can actually build up and carry those credits forward for a number of years. Now, if you don't want to live in a higher tax country than the United States, you would probably want to choose the foreign earned income exclusion. And this allows you to exclude a certain amount of money from US taxation each year. And the number for 2021, so if you're filing in 2022, this is for the 2021 tax year, is $108,700. And if you're planning on moving abroad, that number will go up to $112,000 for the 2022 tax season. So how does it work? You can exclude earned income. So passive income, rental income, that is not earned income. It's got to be earned income, either from a business you own or a business you work for, or some way that you're earning income. And you have to meet one of two criteria. So you have to either be physically present inside a foreign country for 330 days in a 365-day period. That's not the same as being outside the United States for 35 days. You have to be inside a foreign country for a full 24-hour period for 330 days. So if you do that, you qualify under the physical presence test and you get the foreign earned income exclusion. If you miss it, even if you only miss it by a day, you don't get anything. It's not like a sliding scale, it's all or nothing. The other way is if you're a bona fide resident of a foreign country. This is a little bit more murky. It's a little bit more gray, but what the IRS will look at is, do you really live in a foreign country? Do you have a house? Do you have a job? Are you working there? Are your kids in school there? Do you have bank accounts? So, they'll look at all this kind of stuff and say, oh, you know what, this person does look like they actually live there. So they are considered a bona fide resident. And then you don't have to worry about how many days you're inside a foreign country or how often you visit the US and things like that.
Okay, so let me make sure that the impact of this is really clearly understood. If I qualify, and we'll get into the qualifications a little bit more deeply later, but if I qualify for the foreign earned income exclusion, and I make anything from $108,000, $108,700 in 2021 or less, how much federal income taxes will I pay?
If you're at or right under that, you wouldn't pay
Yes.
any federal income tax.
Zero.
Because you'd be able to exclude all of your tax.
So okay.
Even if you earn a bit over that, like let's say you're working for, say you're working for Microsoft and you live overseas. Let's say you're making $140,000 a year, right? So you can exclude that 108,000. You can max out your 401k contribution of 19.5, and then you have your, the standard deduction. You're probably still paying zero, even though you're earning a lot more.
Okay, we should make very clear though that like you said before, this does not have to do with passive income.
Right.
Like if you have capital gains or you get rent or whatever, and you still have to pay your payroll taxes. You have to pay Social Security and Medicare.
Exactly.
So this is just federal income tax in most of the states.
Right.
Almost all
So
states,
your FICA tax, like if you're self-employed, you're still paying both sides of that. So that's 15.6%. If you're employed by somebody else, you're only paying half of that. So you'd still be paying, if you're earning $100,000, you're still paying $7,650 or so in Social Security and Medicare tax.
Right, but the average person, let's say you went to you made $108,700, and let's say your average tax for that, and I can't do the math in my head here, but let's say your average tax rate for that whole span is, let's say, 25%. You would be, if you qualify for the foreign earned income exclusion, you would have about $28,000 in your pockets that you would not have otherwise. Is that, the numbers may be slightly off, but is that the concept?
Yep,
You would pay 28,000 less in taxes. And this is every year. So every year you pay it. And if your wife also qualifies, or your husband, if you're female, if you're filing jointly, you can take double that. Am I correct?
Exactly. So if you have if you're a dual income family, and both people meet the qualifications, then both people can use the foreign earned income exclusion, and there's no marriage penalty on it. So, for 2022, I'm using that because it's easier math. One person gets 112, two people together would get 224. It's not reduced if you're a married couple.
It's like you never made it. It's the same thing as you never having earned it from a tax perspective.
Yeah, it shows up on your tax return as a minus, and then they put the number in, and it just takes that income out of the calculation.
Okay. A lot of people don't know about this, and it's astounding to me. It's like the person that you mentioned earlier. It just costs them maybe $60,000 because their accountant didn't know how to do this.
Yep.
And I know, having gone through it myself with one of your accountants, that you give them the information, they fill out the form. It's just one form, 2555, I think is what it is, if I remember properly. And that's it. And you qualify. Now, let's go over some misunderstandings about this just to make sure that we're clear. And by the way, this would be mainly for people who live in Mexico, because our business Best Mexico Movers, obviously we're dealing with people in Mexico. So they would take the foreign earned income exclusion.
Okay.
Some people think that if you are working for a US company, you get paid in dollars, you don't qualify. Is that true?
No, it's not true. Our company is set up in the United States. We live in Costa Rica, and we qualify.
Okay. And some people think that if you work for a US company, you don't qualify. Is that true?
Nope, it's fine to work for a US company. You just
Okay.
have to be foreign when you're earning that income.
Would it be fair to say that it has, okay, let's look at it the other way. If you're a US taxpayer, my understanding is that you're going to pay federal, you have to file regardless of whether you live outside the United States or not. It makes no difference.
Correct.
And you will pay taxes your entire life if you're a US citizen, period. End of story. So, but you could get some exclusions. Now, let's say that you live in Mexico and you work for a US company, you qualify, you said that.
Yep.
Let's say that you get paid in dollars, you qualify. Let's say that you live in Mexico and you work for a Mexican company and you get paid in pesos. Do you still have to pay US taxes?
Well, you would still have to file a US tax return, but if
Exactly.
you're using the foreign earned income exclusion, you could exclude the 108.7.
Right. So that's what I'm getting at. So it doesn't really, if you're a US taxpayer, regardless of where you live, who you're getting money from, you got to file US income taxes and you got to pay taxes on it.
Yep.
But if you get the foreign earned income exclusion, as long as you meet one of the two tests that we just talked about, the easiest one being you're outside of the, I know you made it slightly different, but you're outside of the US essentially for 330 days out of the year.
Yeah, flip that over. So you're inside a foreign country for 330
330.
days.
Okay, inside of for 335 days, you qualify. So
Yep.
this is not trivial. This is a big deal. Is this something which is just some new sort of wrinkle in the tax code that some smart person like you just figured out and you figured out how to exploit, or has it been around for a while?
No, this has been around for a while. So I had to do some extensive Googling to find out when it first came into effect. But on the americansabroad.org page, I found a bit of a history on it. And it said that it started back in 1934. So it's been around for quite a while now.
Any danger from what you know of it going away anytime soon? Is it even discussed that they will get rid of it?
I haven't heard anybody have a conversation saying that they're going to get rid of this. If anything, it looks like taxes are going to go up in the United States. So I doubt that they would say that expats are going to be treated any different than they are right now.
And is the foreign earned income exclusion just sort of a gimmick or a loophole that is more likely to get me audited than if I claim it than if I don't?
No, you're no more likely to get audited using this than any other kind of deduction that you can use in your tax return.
Okay. Does the taxpayer ever have to pay that money back that they saved on
Nope.
their? Sounds pretty good. So what am I missing? What's the downside? What am I missing?
Well, the downside is it's only 108,000, right? But it is indexed for inflation, so it does go up a little bit each year.
That's why it went up this $4,000 or so, right?
Exactly. Yep.
Well, okay, so as inflation now is going, it becomes even more valuable.
Yeah,
For
exactly.
a number of reasons. One is people are getting pushed into higher tax brackets, and secondly, you get to exclude more. And
yeah,
that, okay.
And the funny thing about inflation is the inflation isn't the same everywhere, right? So even though inflation's running at 6%, 7% in the United States, it doesn't mean that in Mexico it's running at 6 or 7%. So yeah, if you're earning in the United States, your wage may be going up. That might actually be a benefit for you in Mexico, as opposed to your income being eaten away by the inflation monster.
Do you think that, why do you think that the Congress established this, the foreign earned income? Because it sounds almost too good to be true.
My understanding, and again, this is going off this Americans Abroad site, is, for a long time, the United States didn't have an income tax, right? It wasn't until the government started spending, and then, they had World War One, that they said, hey, we need to be able to pay off our debts. So we're going to start charging people an income tax. And from what I've been able to gather, it looks like there were some court cases, people saying, hey, why should you be able to tax me if I'm living overseas and earning my money overseas? So the Cook versus Tate court case back in 1924 said that the government could tax people while they're living overseas. Then there was a movement in Congress saying that, hey, we're handicapping people, we're handicapping US citizens and corporations by saying that, the US is going to tax them, and then they get taxed by another country. So I think that's where the foreign earned income exclusion came in, was basically saying we want our citizens, our diaspora abroad, to be more competitive. So we're going to let them earn some of their income US tax free, so that they're not getting hit with double taxation.
Now that's interesting. And when listening to that, you would think that maybe if you're in a place where you pay very little income tax, or some places you pay no income tax, or some countries I'm talking about, or very little income tax, like for example, Mexico, certainly at the beginning, you pay extremely little income tax. I'm not an expert in Mexico tax laws, but it's very, very small. It doesn't really make a difference. I could live in Mexico, or I could live in a very high tax place, like you were mentioning earlier, like the UK, and we all get the same $108,700. It doesn't make any difference how much, if you live in a high tax place or a low tax place or a no tax place, like Panama or maybe Portugal for some people and so forth. Is that correct?
Yeah, if you live in a high tax place, you'd probably opt for the foreign tax credit, just because that'll be a better benefit for you. But certainly, people that are living in lower tax places, the foreign earned income exclusion is great. And even people who are traveling, like if you're physically present in a foreign country, it doesn't have to be the same country. So if you want to spend 3 months in Mexico, 3 months in Costa Rica, 3 months in Panama, and then 3 months down in Brazil, you're overseas for 12 months. You get to exclude all the income from your US taxes. And so, it's not about being in one place. You can be in multiple places as long as you're inside a foreign country, for 330 days.
All right, so this sounds incredibly great. And I must say that I've mentioned this to some of my clients who are moving to Mexico, who were completely ignorant of it before. And they wanted to kiss me and send me flowers and everything, because it's a lot of money. It's a lot. And like we like to say here in Mexico, that's a lot of tortillas. That's a lot of tortillas. Especially if you're in a place like Mexico where it doesn't cost anywhere near as much to live to a similar type place in the United States. And you also don't pay income taxes if you're single on the first $108,000, $108,700 that you make. That's a pretty sweet deal. So let's make sure that we're clear on what we need to do in order to qualify. And you talked earlier about the two tests where the taxpayer has to qualify under one, but not both of the two tests.
Correct.
So let's go over the two tests, the physically present and the bona fide. Please, let's be just incredibly clear. I know you went over it a little bit before, but let's just be real clear, and maybe I'll ask some questions as we go along.
Sure. So the physical presence test is how pretty much everybody has to qualify in the beginning. And that says that you are physically present inside a foreign country for 330 days in a 365-day period. So this isn't January to December. It can go from July to June of the following year. And it just matters that you're physically inside a foreign country for 330 days.
All right, so then they can't take that away from you. If that's true, what you just said,
Mhm.
under all circumstances, they qualify, period.
Right. And it's
Correct?
for a full 24-hour period. So travel days don't count as being inside a foreign country.
Okay, so leave a little slack in there. Don't take it to
Yeah.
the very last day. You may
Well,
be rudely surprised.
I always tell people, leave yourself a couple days slack, because it's not a sliding scale. It's
Yeah.
not like if you go over by one day, you get 100,000 instead of 108. It's all or nothing. It's like a switch. It's on or it's off.
But you
So
could
make sure.
prorate.
What's that?
I would, you sort of mentioned this. You could in other words, it doesn't have to be a calendar year. If
Right.
this were the case for half a year, you get half a year. How does that work?
Well, just like you're saying, so you would get part of it on the, let's say we're talking about 2020 and 2021, right? You move
Right.
overseas in July 2020 and you stay overseas all the way until the end of June 2021. So when you file your 2020 tax return, you can file an extension saying, hey, I'm going to be overseas. It's 2350 is the extension form. I'm going to be overseas. I want to qualify for the Foreign Earned Income Exclusion. And you get a special extension for doing that. So then after June, after you hit your 330 days, you would file that tax return and you would get the 6 months worth of credit for the 2020 tax return. And then in your 2021 tax return, you could, if you stay abroad, you could get the full year credit, or you could just get the 6-month credit for being overseas from January through the end of June 2021.
All right, that sounds great. So, and as you mentioned before, most people, when they start out claiming the foreign earned income exclusion, they start out with a physically present test because it's very difficult to sort of establish that, yeah, you're living in, as an example, Mexico permanently when you just got there.
Right.
So,
and the bona fide resident test, one of the rules is that you have to live abroad for a full calendar year before you can even apply using that one.
Okay, I didn't know that. Okay, very good. So most people would start out with a physically present. They make sure that they're living in the foreign country for 330 days. Let's make it 333 days, just to be, to give them a couple, make sure they're not rudely surprised, because we're talking about a lot of money. And then they do certain things, which you mentioned earlier, that you said is a murky area, which makes me a little nervous because we're talking about a lot of money. Tell us once again what we would tell the IRS to establish if we're not physically present. Let's say that for whatever reason, I was in the United States for 60 days during 2021, but I really do live in Mexico. And I claim the foreign earned income exclusion. What's the IRS going to do? And what am I going to do?
When you fill out Form 2555, you have to put in the dates that you were in the United States on that form. And if you ever got audited, they'd probably ask for photocopies of your passport showing when you were overseas and things like that. So, let's say, Chuck, that you moved to Mexico 4 or 5 years ago. In 2021, you went back to the US. You're in the US for 60 days. Now, if you were working, you would not be earning foreign earned income for those 60 days. So those 60 days, you are taxable in the United States, okay? Now, if you're a bona fide resident, so you went back, you're in Mexico from January until July 1st, and then at the end of August, you go back to Mexico. So for July and August, you're in the United States, and you're paying taxes on your US sourced income for that period of time. The rest of the year, the IRS says, hey, we need to make sure you actually live overseas. How do you want to prove it to us? And you say, well, I have a lease on a house here, and I've been renting the same house for 3 or 4 years. So, here's a copy of my lease document. Here's my utility bills. Here's my bank statements showing that I've been living here for a long time and I've been paying my utilities and doing all that kind of stuff. Here's my dog's veterinarian records showing that my dog is here in Mexico with me, and he's seeing a vet here in Mexico as opposed to a doctor in the US or something like that. So it becomes a series of things that you have to do to show the authorities if you got audited. It's only if you got audited that you actually do live there. And the other part of the bona fide resident test is that you have no intention or no immediate intention of returning to the United States. So if you're a contractor, if you're on like even a 1-year contract, something like that, the default assumption is at the end of your contract, you will return to the United States. So you can't be a contractor, you'd have to be an employee. It can be of a US company, but you have to be an employee, not a contractor, to use the bona fide.
Okay. So if I can show, let's say I have a house, I have now, excuse me, if I still had a house in the United States, or I rented a house in the United States, that wouldn't help me with the bona fide, would it?
Well, it depends on what you're doing with the house. So, we see a lot of people, they've got a place in Colorado that they're Airbnb-ing, and people are renting it to go hiking or skiing and things like that. That's not going to have a big impact on you, because that's almost like having a separate little business that's in the US, right? If you have a house that is a vacation home, that's perfectly acceptable. That's allowable, but you have to really be living overseas. You can't just be saying, hey, I'm in Mexico for 6 months of the year, and then I'm in the US for 6 months of the year. That probably wouldn't pass mustard with the IRS.
Have you seen any of these cases where people got audited and they had to prove it, and any lessons learned from that on what flies and what doesn't?
I haven't seen a lot of audits in this space. My wife and I actually got audited a bunch of years ago, and they just we sent them photocopies of our passport, and they could see the stamps for the countries we were in and stuff like that, and that was the end of it.
Okay, well, David Mckeegan, thank you for sharing with us something that seems too good to be true but isn't.
Oh, my pleasure.
And also a very, very easy way for expats to talk to someone who knows what they're doing, who can get this done properly, because there are ways to mess it up. There are definitely ways in which to not do it properly, and we're not talking about a trivial amount of money. So I highly recommend talking with David and his accountants. How many accountants do you have there now, David?
We're at about 45 accountants at the moment.
Okay, so this is once again not a trivial company, and if they want to get in touch with your business, how do they do it?
The best way is just right on our website, greenbacktaxservices.com.
Okay, very good. Well, you've accomplished quite a bit, young man, at an early age. Thank you very much for sharing this really important information, and I'm sure this will put a lot of money into a lot of people's pockets, and for that, they and I shall be forever grateful.
Oh, that's fantastic. I hope so. Thank you, Chuck.
Thank you, David. Bye-bye.